Indonesia's hilirisasi, or downstreaming strategy, is a state-directed effort to build a global electric vehicle battery ecosystem. This requires the construction of massive, hyper-modern smelting complexes to process the nation's vast nickel reserves. To fund this infrastructure, the domestic financial sector has mobilized significant capital. Commercial bank loans to the base metal processing industry have surged 160% in a few short years. Banking statistics show total credit 910 trillion rupiah by 2025. At the bottom of this chart is the non-performing loan ratio, tracking loans in default. It sits at just 1.8%. Credit is surging, yet reported repayment rates remain near perfect. This occurs because of how these megaprojects are financed. Many of these loans utilize multi-year grace periods on principal repayments, meaning borrowers are not yet required to fully service their debt. The 1.8% default rate is a lagging indicator. It reflects the structure of the grace periods rather than the commercial health of the projects, masking a systemic vulnerability accumulating within the banking system. To understand the threat of this 910 trillion rupiah exposure, we have to map exactly where this debt is held across the financial sector. This network map shows 75% of that exposure is held by just 5 central nodes, the nation's systemically important banks. This capital funnels directly into a handful of megaprojects. The government designates these smelters as Proyek Strategis Nasional, or PSNs, National Strategic Projects. This designation provides streamlined licensing, but it also creates an implicit assumption among lenders that the state will step in if a project of this magnitude begins to fail. This leads to a moral hazard, where banks underprice the long-term risk. They rely on the physical project assets as collateral, rather than pricing in the volatile variables the projects actually face. By combining state-backed optimism with concentrated lending, the industrial policy has lodged a significant concentration hazard at the core of the financial system. The factors that actually threaten the solvency of these projects are non-financial variables that sit outside the bank's direct control. This is a smelter's debt service coverage ratio, or DSCR, the metric used to determine if a project generates enough cash to pay its debts. Inputs like production volume and market price feed into revenue, which must outweigh debt obligations to keep the system green. The central input, the global price of nickel, is historically volatile, subject to unpredictable cycles of demand and supply. The value of the collateral sitting in Indonesian industrial parks is ultimately decided thousands of miles away, on trading floors like the London Metal Exchange. Currently, global oversupply has pushed those prices down, hovering around $16,500 per ton. Applying this price drop causes the revenue block to shrink. The final ratio drops below the default threshold, turning the logic tree red. Internal stress tests indicate that if these depressed prices persist for another 12 to 18 months, many of these loans will breach their DSCR covenants. The second risk vector stems from the capital and technology that built these smelters, an entanglement known as the China nexus. While Chinese investment accelerated Indonesia's processing capacity, it has also imported geopolitical vulnerability directly onto domestic bank balance sheets. The threat comes from the United States Inflation Reduction Act, specifically the rules governing Foreign Entities of Concern, or FEOC. These rules restrict tax credits for EV batteries that use critical minerals processed by facilities with significant Chinese ownership or technology. This creates a bifurcation of the global nickel trade. A single supply stream effectively splits into a premium, IRA-compliant tier for Western markets and a discounted, non-compliant tier for nickel processed with Chinese technology. When Indonesian nickel is forced to sell at this discount, the revenue assumptions written into the bank's syndicated loans are invalidated. Foreign trade policies and techno-nationalism are material credit risks that standard banking models are currently unable to quantify. The third risk vector is transition risk, the possibility that these massive industrial assets could be rendered obsolete by policy or technological shifts. Most of Indonesia's capacity relies on RKEF smelters, powered by captive coal plants. RKEF is the rotary kiln electric furnace process, which produces some of the most carbon-intensive nickel in the world. This carbon intensity triggers the European Union's Carbon Border Adjustment Mechanism, or CBAM. By 2030, CBAM could impose carbon tariffs of 10 to 20% on these exports, effectively pricing Indonesian products out of European markets. Simultaneously, a technological threat is emerging that could bypass the need for nickel entirely. Breakthroughs in sodium-ion batteries, which use cheap, abundant materials, threaten the 30-year nickel demand projections that justify these current smelter loans. Indonesian banks are extending 30-year financing for projects that could become commercially stranded assets due to carbon tariffs or battery innovations long before the loans are repaid. If these multi-vector risks are so severe, why aren't the guardians of financial stability identifying them? The Otoritas Jasa Keuangan, or OJK, is the primary body responsible for this oversight in Indonesia. OJK operates on a comprehensive framework aligned with Basel III principles. However, this architecture is reactive, built to monitor a diversified economy rather than manage a state-directed industrial concentration. Current stress testing models are fed traditional macroeconomic inputs, outputting a green, system-healthy signal. But when we input our specific vectors, a nickel price drop, a carbon tariff, and a US supply shock, the system errors out. The variables are not recognized. Regulators are attempting to identify modern, techno-nationalist vulnerabilities using conventional macroeconomic tools pointed in the wrong direction. Managing this concentration requires a shift in OJK's posture, moving toward a preemptive, risk-differentiated framework. This diagram outlines the necessary tools. The foundation is a sectoral counter-cyclical capital buffer, or CCYB. This buffer requires banks to stockpile capital reserves specifically during commodity boom times, creating a shock absorber before a market downturn occurs. To address the hazard at the top banks, the framework adds through-the-cycle provisioning and Pillar 2 capital add-ons. Pillar 2 add-ons would impose specific capital charges on banks that cross exposure thresholds, forcing systemically important institutions to diversify their lending away from a single commodity value chain. Finally, the framework requires abolishing the moral hazard of the PSN designation by mandating price-sensitive and ESG-linked loan covenants. These tools would transform the banking sector, providing shock absorbers specifically tailored to withstand the swings of commodity cycles. The final vulnerability cannot be fixed by OJK alone. There is an institutional silo isolating economic planners from financial risk regulators. Bridging this gap requires a specialized non-financial risk intelligence unit within OJK, capable of modeling geopolitical and technological scenarios. It also requires a formal subcommittee under the Financial System Stability Committee to mandate direct coordination between industrial policymakers and financial stability guardians. This coordination synchronizes industrial targets with the capital requirements of its largest banks, preventing growth ambitions from outstripping the financial system's resilience. The financial sector can no longer treat geopolitics and the green energy transition as external factors. To protect national stability, regulators must evolve to read the geopolitical landscape as fluently as they read a balance sheet.